You're scrolling through real estate listings at midnight. Every house that doesn't look like a total renovation nightmare cost $500,000. Meanwhile, your parents and every finance influencer online are telling you the same thing. Renewing your lease is a failure of adulthood. This diagram shows the problem. The median household income in America is about $84,000. Yet we are asking people to buy homes that cost 6 times what they make in a single year. Stretching your budget to accommodate a 6-to-1 income multiple creates a financial imbalance that most household budgets struggle to sustain over the long term. The financial pressure starts before you even move in. To avoid extra fees from the bank, you need a standard 20% down payment. On a $500,000 house, that requires $100,000 in liquid cash. Look at the gap on this chart. The requirement is $100,000, but the median American only has about $8,000 in savings. You are $92,000 short of the target. Since most buyers lack that upfront cash, the traditional path to homeownership requires taking on a much larger debt burden than those who can afford a full down payment. Let's run a simulation. We'll call this Path A. In this scenario, you manage to scrape together exactly half of the required down payment, $50,000. Because you didn't reach that 20% threshold, the bank adds private mortgage insurance, or PMI. This is a monthly fee you pay to protect the lender's investment, adding about $300 to your bill. This block represents your starting point, a $2,850 base mortgage payment for the remaining loan balance. Then the localized costs hit. Property taxes stack another $500 onto that monthly total. Homeowner's insurance adds another $300 to the stack. Finally, we apply the 1% rule for maintenance. Reserving funds for when a pipe bursts or the HVAC system breaks adds $417 a month, bringing your total housing cost to $4,367. If you're making that median income, your take-home pay is around $5,400 a month. That means you are spending a massive 80% of your disposable income just to stay in the house. Now look at Path B. You decide to reject the house trap and rent a comparable home for a fixed rate of $2,500 a month. In this scenario, structural disasters and rising property taxes are the landlord's responsibility, not yours. Your monthly housing cost is capped. This creates a massive opportunity. By renting, you keep the $1,867 difference that Path A was spending on interest, taxes, and maintenance. Watch the green line on this chart as you invest that $1,867 every month into a simple S&P 500 index fund for 20 years. Assuming average historical market returns, that monthly investment compounds until the final figure hits over $1.1 million. One path leaves you with an illiquid house that constantly drains your cash. The other leaves you with $1 million liquid portfolio. When you look at the math, you have to ask why the stigma against renting remains so strong. On a single mortgage, the bank collects decades of interest, the real estate agent takes a commission on the sale, and the insurer secures a long-term policy. But nobody in those industries gets a check when you decide to quietly invest your money in an index fund instead. The pressure to buy persists because these institutions capture their highest margins when homeowners commit to the high-volume interest and transaction fees of a 30-year mortgage cycle. Real wealth isn't a property deed you can barely afford. Real wealth is having enough breathing room in your budget to sleep without financial anxiety. If the numbers don't make sense, walk away. There is no shame in being a renter while you build your $1 million margin. Stop chasing emotional illusions.